3 days ago, SpaceX went public. And the bigger the stock runs over the next few weeks, the more insider shares get dumped on the people buying it today. That is not a coincidence. It is a clause, and it is printed in the prospectus. I know that sounds dramatic, so let me earn it. Somewhere in Manhattan right now, a group of bankers is watching SPCX trade. Every tick higher, they smile a little wider. Not because they own the stock, but because of a trigger they helped write into the lockup agreement. The higher the price climbs, the sooner that trigger fires. The pop everyone is celebrating is not a victory lap. It is a countdown. Before I go further, let me be honest about what this video is and what it is not. This is not a video about SpaceX being a bad company. By almost any measure, it is an extraordinary one. In 2025, it accounted for nearly 90% of all payload mass sent to orbit across more than 160 successful launches. Starlink now serves millions of customers across more than 150 countries. The defense pipeline runs deep. So if you came here for someone to tell you the rockets will not fly, that is not what this is. This is about something different and, in a way, more important. It is about the gap between a great company and a deal structured to favor everyone except the person buying today. Those are not the same thing. And the gap between them is exactly where ordinary investors lose money on deals like this one. Everything I am about to show you lives in a public document. It is in the prospectus SpaceX filed with the SEC, the S-1. Anyone can read it. And yet almost none of the coverage you have seen has touched it. By the time we are done, you will have a calendar with specific dates on it, and you will understand why those dates matter more than the price on your screen right now. One quick anchor on price, because it matters for everything that follows. SpaceX went public at an IPO price of $135 a share. It opened at $150, traded as high as the mid-170s, and closed its first day up about 19%. That put the implied valuation somewhere between $1.7 and $2.1 trillion, depending on the hour. The offering raised roughly $75 billion, which makes it the largest IPO in the history of the stock market, bigger than Saudi Aramco. Here is the number that should stop you. At that valuation, against last year's revenue of about $18.7 billion, investors are paying roughly $94 of valuation for every single dollar of sales. 94 to 1 for a company that posted a net loss of nearly $5 billion last year. For comparison, NVIDIA, one of the most profitable technology companies on Earth, trades at less than a quarter of that multiple. To give you a sense of how stretched that is, Morningstar, one of the most respected independent research firms in the country, ran its own discounted cash flow valuation of SpaceX. Before the IPO, it pegged fair value near $780 billion. After the listing, it tightened that to about $63 a share, which is more than half below where the stock is trading. ARK Invest, on the other end, sees a path to $2.5 trillion or more by 2030. The distance between those two estimates is wider than the entire market value of most countries' largest companies. So when I say this deal is structured to favor everyone except the person buying today, that is not a feeling. That is a spread. The valuation already assumes the future has arrived. Everything that comes next is about who profits if it does not. Let me build this from the ground up, because the rest of the video depends on getting it right. When a company goes public, only a small slice of its shares actually start trading on day one. In SpaceX's case, that slice is tiny. Only about 4% of the company is in the public float. The other 96% is still held by the people who got there first. The founders. The employees. The venture firms that funded SpaceX for over 2 decades. Those insiders are not allowed to sell yet. They are contractually locked up. The logic is simple. If everyone who owned cheap shares could dump them on day one, the supply would crash the price instantly. So almost every big IPO uses a lockup period, usually 180 days, to hold that supply back. Now here is where SpaceX did something unusual. Instead of one cliff at the end of 180 days, The way Rivian did, the way Uber did, the way almost every big IPO does, SpaceX built a staggered release schedule. 5 separate time-based tranches that unlock at fixed intervals. 2 additional cliffs tied to earnings reports. And 1 performance trigger tied to the share price itself. That last part is the one I want to spend a minute on, because it is the part the headlines are skipping. Here is what the prospectus actually says. If SPCX trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares unlocks for sale early. Read that one more time slowly. 30% above the IPO price. 5 of 10 days. Before the first earnings report. The trigger fires and 10% more insider supply hits the market. The IPO price is $135. 30% above that is $175.50. So the threshold is not theoretical. It is a specific number. Any trading day where SPCX closes at or above 175.50 counts toward that 5 out of 10. Here is the part that should make you pause. The stock already traded into the mid-170s on its first day. It is sitting right at the doorstep of the trigger in week 1. This was never a level the stock would have to soar to reach. It is a level the market is already testing. 1 good week. That is all it takes. So the clause does something most retail investors will never notice. It turns the day 1 pop, the thing everyone on financial media is celebrating, into the starting gun for early insider selling. The harder the stock runs in the first few weeks, the faster that 10% of locked-up insider shares becomes free to sell. The pop is not the celebration. The pop is the trigger. That is the clause. That is the mechanism. Now let me show you the calendar. Picture a calendar pinned to a wall. Day 0 is the IPO. SpaceX is now publicly traded. About 4% of the company is in the float, and 96% is locked up. Now walk forward with me. Around day 70, the first of 5 staggered tranches unlocks. 7% of eligible insider shares become sellable. Day 90, the second tranche, another 7%. Day 105, the third tranche, 7%. Day 120, the fourth, 7%. Day 135, the fifth, 7%. That is 35% of insider shares released across 5 dates, roughly late August through late October. And those are just the time-based unlocks. 2 bigger cliffs land in between, tied to earnings. The first cliff fires after SpaceX reports its first quarterly earnings as a public company, the quarter ending June 30th, with the call expected around early September. When it lands, up to 20% of insider shares unlocks at once. That is bigger than any single staggered tranche. And on top of that sits the performance trigger, the extra 10% if the price held above that 30% line. The second cliff is even bigger. After the third quarter earnings report, expected in late October or November, another 28% unlocks. Then comes day 180. The standard lockup expiration, around early December. Every restriction that has not already lifted, lifts now. Add it all up and the math closes cleanly. 5 tranches at 7% each is 35. The first earnings cliff is 20. The second is 28. That is 83% of insider shares released before the calendar even hits day 180. The final 17% unlocks at the standard expiration. By early December, 6 months from the IPO, nearly all of the insider supply is free to trade. 6 months. That is the timeline you should be thinking about, not whatever the stock does in the first hour. And there is one more wrinkle the headlines barely mention. Roughly 5% of the deal is a friends and family carve-out that carries no lockup at all. That is around $3.5 billion of shares that can be sold starting on day 1. So even the day 1 float is not as locked down as the 96% number suggests. There is also one date worth marking a full year out. Around day 366, Elon Musk's personal lockup ends. We will come back to why that date changes the whole picture once you see it. So here's the question. Why would SpaceX design a lockup like this? Why not just use the standard 180-day cliff that every other big IPO uses? The answer is that this schedule was built to do three specific things, and once you see them, the design stops looking neutral and starts looking deliberate. The first thing it does is avoid the cliff drop. When Rivian's lockup expired, the stock dropped about 25% in a single week after Ford and others moved to sell. When Uber's lockup expired in November of 2019, the stock hit an all-time low on the expiration day itself, sitting around 40% below its IPO price. When Palantir's first lockup lifted, the stock fell sharply in a single session as insiders sold tens of millions of shares. Cliffs are brutal. Cliffs are visible. Cliffs make headlines. A staggered schedule diffuses that pressure across a dozen smaller dates that nobody outside the prospectus is going to track. The second thing it does is accelerate float growth, and this is the part that should genuinely surprise you. Remember that day one float of about 4%. The faster that number climbs, the higher SpaceX qualifies to be weighted in major indexes, especially the Nasdaq 100. Under a rule Nasdaq amended just before this IPO, a company can be added to the Nasdaq 100 in as little as 15 trading days after listing, instead of the 3 months that used to be required. Independent analysts estimate that index inclusion alone will force somewhere between $8 and $12 billion of passive buying in the first month, with total passive purchases potentially reaching $30 billion over time. That is forced demand pouring in from every fund that tracks the index on rules that were rewritten months ago. So every tranche that unlocks is not just releasing supply for insiders to sell. It is also clearing the path for institutional buying to flood in. That is not an accident. That is a feature. The third thing it does is the part nobody says out loud. It gives insiders predictable exit windows on dates they can read in the prospectus today. Day 70. Day 90, Day 105, Day 120, Day 135. 2 earnings cliffs in between. The performance trigger sitting on top. None of these are secret. They are all public. They are just buried in over 370 pages of legal language most retail buyers never open. The asymmetry is not about access to information. It is about who actually reads it. None of this is illegal. None of it is even unusual for a deal of this size. It is just engineered. And the people who engineered it did not engineer it for you. I know I am asking you to take a lot on faith, so let me anchor it in what actually happened to other companies when their lockups expired. Palantir went public in September of 2020. Retail enthusiasm pushed the stock from around $10 at listing toward the high 30s by early 2021. Then the lockup expired. Insiders sold tens of millions of shares into the premium that retail had built. The stock fell sharply in a single session and spent months recovering. The expiration date was printed in the prospectus from day one. Almost nobody buying near the top was tracking it. Rivian went public in November of 2021. The opening day was electric. The stock jumped more than 20% above its IPO price, and a lot of buyers took that pop as proof they needed to get in fast. 6 months later, the lockup expired. Ford disclosed it would sell its stake, and the stock dropped hard. Over the year that followed, it fell roughly 2/3 from its peak. Every one of those dates was visible to anyone who looked. Uber went public in May of 2019 at $45 a share. By the time its lockup expired that November, the stock had been struggling, and on the very day insiders were finally allowed to sell, it hit an all-time low, sitting about 40% below its IPO price. The headline writers framed it as a coincidence. It was not. Even Snowflake, which used a staggered schedule, the closest analog to what SpaceX is doing, was not immune. Its final expiration week alone dragged the stock down by double digits. The pattern across all of these is clean. The higher the speculative premium at the IPO, the more painful the expiration tends to be. SpaceX is going public at roughly 94 times last year's revenue. That is the steepest premium of any major IPO in years. By that measure, the room for things to get rough on the unlock dates is unusually wide. None of those 4 companies were bad businesses. Most are still around. Some have recovered fully. The point is not that SpaceX is going to collapse. The point is that the part of the deal that hurt retail investors in every one of those names, the unlock, is the part that is still ahead of us in this one. Now let me come back to that data year out. Day 366, when Elon Musk's lockup ends. Musk controls roughly 42% of the equity and about 85% of the voting power. He is the founder, the public face, the entire story in a lot of ways. And in the prospectus, he committed to a 366-day lockup. He cannot sell a single share for a full year. Not at day 70, not at the earnings cliffs, not at the standard expiration, not even if the performance trigger fires. He is locked out of all of it. Every headline will call that a positive signal. And on its own terms, fair enough. The founder is not dumping shares on day 1. That matters. But here is the part those headlines skip. Every other insider, the early employees, the early venture firms, the executives below the very top, is on the schedule we just walked through. Their first chance to sell starts within the next 90 days or so. By the time Musk's lockup even begins to lift, the rest of the insiders have had a full year of unlock windows to cash out into retail demand. A full year of opportunities for the people who got there first to sell to the people who got there last. The person at the top is protected. The people in the middle get multiple exit doors over the next 6 months. The person buying tomorrow on their phone, watching the ticker climb, is the demand all those exits are pointed at. The whole structure makes more sense once you see it from above. Musk does not need to sell in the next year. He holds majority voting power, and a public lockup signals confidence. The early employees and venture firms do need to sell. They have been waiting years to turn paper gains into real money, and they have fund timelines and clients waiting on returns. So the deal lines up nicely for both groups. The founder gets credit for staying locked. Everyone else gets the timing windows to cash out. The only people the structure does not line up for are the ones absorbing all of it. Same prospectus, same company, 2 completely different deals depending on which side of the lockup you are on. So, where does that leave you if you are genuinely drawn to this company? Because watching everything I just laid out is not the same as saying never touch SpaceX. There is a smarter path than the 2 loud options. The first loud option is to chase the hype. Buy today at the popped price, right before the trigger window opens and the tranches start unlocking. We have now seen, step by step, why that is the weakest seat in the house. The second loud option is to write off the whole thing forever on principle, which throws out a genuinely remarkable business because the deal structure was unfair on day 1. The third path is quieter, and it costs you nothing but patience. You let the calendar do the work that hype is trying to rush you past. 6 months from now, every restriction on the staggered schedule will have lifted. The first earnings report will have landed, real numbers on the record you can hold the company to. The second earnings report will have landed too. The performance trigger window will have closed, one way or the other. The forced index buying will have run its course. Every one of those events is a piece of real information replacing speculation. None of it requires you to predict anything. It just requires you to not be in a hurry. Here are the dates worth marking on your own calendar, not for trading, but for sanity checking the story as it unfolds. Late August through late October is the staggered tranche window, 5 dates, 7% each. The first earnings report, expected around early September, watch what gets disclosed and whether the performance trigger has fired. The second earnings report, expected in late October or November. And early December, when the standard expiration arrives and the last slice of insider supply goes free. By the time that final date passes, the price will reflect 6 months of reality instead of 1 day of countdown. That is the price worth deciding on, not the one on your screen right now. Here is the part worth holding on to. The best companies of the last few decades stayed viable for years after their IPOs. You did not have to own them on day one to do extraordinarily well. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you today as a once-in-a-lifetime, act-now moment is almost always a stock that will still be there next quarter, and the quarter after that, at a price set by reality instead of a countdown clock. The single most important thing in this entire video was not the calendar. It was the habit of reading deal mechanics before deal headlines. That habit works on any IPO you will ever consider, not just this one. The trigger clauses, the unlock schedules, the float math, the index inclusion rules. They're all sitting in public documents months before the price action ever starts. The advantage is not access. The advantage is reading. The number on the screen today is loud. The calendar is quiet. The number fades in a day. The calendar runs for a year. Pick which one you let make your decision. I am Jenna. I will see you in the next one.